Good day, dear grade 10 learners, and thank you once again for the opportunity to assist with depreciation on accounting. So let's just track back a little bit. What is depreciation and where does it fit into the whole process of accounting? So from grade 8 and grade 9, you have now studied the cash journals, your cash receipt journals, your cash pay journals. You have studied the petty cash and how that works, the petty cash journal, and the debtor creditor journal, and how that all then transfer to your general ledger. From your general ledger, then you are going to create a trial balance. This trial balance is also not then the stop or the complete of the accounting cycle. This trial balance is merely the beginning then of the last step in our accounting cycle, which is then the financial statements. So for the trial balance, then we are going to look at all the balances in the balance sheet to make sure that they reflect the correct value. And depreciation is basically where we look at the fixed assets of the balance sheet and see that obviously we have used these fixed assets, but is the value that we display in the statements, are that the correct value of these assets, taking into account that we have used that asset? So let's dive in. What is depreciation? So depreciation is where you allocate the cost of a tangible asset over the useful life. So this is basically an amount that you in accounting show the amount that you have used this fixed asset to then generate some financial income. What is the key concepts then for this? So first of all, depreciation is only on fixed assets, and fixed assets are those assets that you have bought for a long-term usage, and they are used to generate some income. Like for your vehicles, let's think about a delivery vehicle where you use that vehicle to deliver the inventory that you have sold to customers. Equipment, for example, your printers, your IT equipment. So those are all the things that you use in the production of your income, of your inventory. We have two methods of depreciation. The first method is then the straight line method, and the second method is our diminishing balance method. We're also going to look at the accounting entries. Why do we debit the expense and why do we credit the accumulated depreciation? And we're also going to look at how does this impact my financial statements by means of the income statement and the balance sheet. Let's go to the first one, the easiest one of the two, the straight line method. So basically the straight line method is where we take the depreciation will be based on the cost price less your residual value. So what is residual value? Residual value is that value that you believe you will have at the end of its useful life. So let's take for an example a motor vehicle where you have purchased it for 1 million rand. Okay, you believe at the end of the useful life, normally a vehicle is over 5 years, you believe that at the end of this 5 years, this vehicle will only be valued at 250,000. Okay, so you will not have depreciation on that residual value because you are not going to use that vehicle for that last 250,000 rand. Alrighty, So therefore we had to take the cost price less your residual value divided over the useful life. I just quickly want to stand still on this. So when we calculate depreciation, we can give you the rates by two ways. The first way is to give it to you via the useful life. So we say to you, this asset will be used over the next 5 years. Or we can give it to you by means of a rate. Say, for instance, 20%. That is actually then the exact same thing, it's just a matter of how we're going to use that. So because we want to know what is the depreciation per year, we're going to divide that, the useful life, over the 5 years. But if we tell you that the rate is 20%, then we're gonna times that with 20. But I will show you in examples. So on the straight line method, your depreciation is then the same for the 5 years, for example. Remember, all of this, what I'm saying now, is based on the fact that this is the first year that we use this asset, and we have bought this asset on the first day of the financial year. So the asset was used for the full 12 months in this financial year. Let's look at the diminishing balance method. In plain English, diminishing means reducing balance. Okay, so we are going to base this depreciation on a reduced balance each time. So the depreciation will be based on the carrying amount, carrying value, or you will also see they talk about book value. Everything is the same thing. Carrying amount is basically the amount at what the carrying amount, the start of that financial year, that balance. Say for instance that we had a vehicle for already 2 years, and this year is year number 3 that we have to calculate the depreciation. Alrighty. So what is the carrying amount? It will be my cost price less residual value, if there is a residual value, less the previous 2 years of depreciation. That is basically my carrying amount. Let me just rephrase. My carrying amount is my cost price less my previous years of depreciation. The residual value, that will only be used when we calculate the depreciation. That is not influenced by your carrying amount. I'm so sorry. And can you see here in this formula, we have given you the depreciation rate, meaning that we will times it with that 20%. So the depreciation decreases each year because with each year that have passed, we have used this asset, so there is depreciation. So my book value, carrying value, or carrying amount will reduce each year. So we are basically on the reducing balance method. Let's look at some examples of just practically how this works. So on the straight line method, okay, so we have equipment, cost price is 60,000, residual value is 6,000, and the useful life is then 6 years. Okay, so let's think about it. So what is my depreciation based on? Well, it's based on the 60,000 less my residual value of 6,000. So the value that I have to calculate depreciation on is the 54, everybody with me, divided by the 6 years. So my depreciation for the next 6 years if we have full years, will be then the 9,000. Let's look at how it will change when we are using the diminishing balance method. So the figures are exactly the same. Okay, so if we have purchased it on the first day of my financial year for year 1, what will be my depreciation? My depreciation will be my cost price less my residual value divided by 6. So that is the 9,000. How will that differ then from year 2? Well, remember we are busy with the diminishing balance method. So for year 2, we will have to take into account the previous years of depreciation. We call that accumulated depreciation. So it's my 60,000 less my residual value less the previous year's depreciation divided by 6. And can you see my depreciation is reducing, and therefore the name of diminishing balance method. Year 3, so there is my 60 less my residual value, and those 2 years, the 9,000 and the 7,500, those are my accumulated depreciation for the previous 2 years divided by 6. So in year 3, my depreciation will only be 6,250. So can you see where the name diminishing balance is coming from? It is being reduced with each year. Alrighty. Now this is the plain simple ones. Let's look at when we have to proportionate the depreciation. What does that mean? That means it's not always an easy example where we have purchased equipment, fixed assets on the first day of the financial year. Sometimes we are buying financial or assets during the year, not always at the beginning. So we will also have to make sure that we understand that we are only going to depreciate that asset for the months that you have used this asset. And this is then also very important because remember, we want our financial statements to be accurate. So therefore, we will also have to proportion this depreciation if that asset was purchased during the year. Let's look at the formula for that. So what is the formula? So we will calculate what is the annual depreciation. Remember, the annual depreciation can be based on either the straight line method or it can be based on the diminishing balance method. Okay, but then we times it for the months that we have used it divided by 12. Alrighty, let's look at our first example. So the straight line method. So our financial year end is 28 February 2025. We have bought this equipment on 1 September 2024 for 120,000. 6 years is our useful life. We don't have a residual value. Just want to stress this as well. If the question is silent on the residual value, then you don't need to worry about residual value. So if the question doesn't state anything of residual value, then it simply means there is no residual value for that specific asset. Alrighty, so let's look at what is the depreciation. So for the straight line method, we will take the 120,000, no residual, but for over the 6 years useful life. But remember, we have not bought this asset on the 1st of March 2024 which will be the beginning of our financial year end. Okay, we have bought it in 1 September. And now I want you to use your fingers. Okay, so let's start to count. 1st of September, so we're going to use the asset for the whole month of September. So September is 1, October, November, December, January, February. So we are going to use this asset only for 6 months into this financial year. So we have to proportion that 20,000 with 6 months to get the depreciation for this equipment was 10,000 Rand for this current financial year. Let's look at when it is in the diminishing balance method. So my equipment was bought on 1 July for 80,000. 20% is the useful life. Can you see the difference? So we either gave you in years or a percentage. Okay, so 20% we know that is 5 years. How do I know it's 5 years? Because 20 is going divided into 100 5 times. My year end still 28 Feb. What is my annual depreciation? Can you also see that we did not say anything about the residual value? So therefore, you ignore the residual value. So the annual depreciation is then 16,000, but we have only used it for how many months? Let's count. We are going to use it for the whole of July, August, September, October, November, December, January, February. So that is for the 8 months. We are using it for 8 months. So the depreciation based on the diminishing balance method is then 10,667. It's not on the slides, but let us think about it. What will happen then in year 2? In year 2, what is the diminishing balance method? We take into account what is the previous years of depreciation. So we start off with the 80,000 less my 10,600, okay, times 20%, or divide by 5, same thing. Okay, we will not proportion that for year 2 because now we are using this equipment for the full financial year, for the full 12 months. What will be my journal entries for depreciation? When I was in grade 8, the teacher there, she bombarded us with the rhymes that say asset, or let's say for example, bank is an asset, assets will increase on the debit side. Expenses will increase on the debit side. Okay, so guys, if you don't know that rhyme, please let us know, then I can teach you that. Very important, and I promise you guys, I am using that little rhyme until today when I am struggling to make sure if it is a debit or a credit. That is my rhyme that I'm going to. So we know that depreciation will now is an expense, and expenses will increase on the debit side, and therefore I debit my depreciation, the expense. And then what is my other leg? My other leg is then accumulated depreciation. And what is accumulated depreciation? Well, as I said to you earlier, that is the accumulation of all the depreciation. But this is where we show what is the leg that goes against the actual asset in the balance sheet. So your accumulated depreciation is then, we call them negative assets. Okay, So it is then netted off against the asset itself. So we know that assets will reduce on the credit side, and therefore we are reducing that asset. So we are crediting the accumulated depreciation. And just then on the side note that depreciation is not a cash flow item, so it does not affect any cash flows. Okay, let's look at the impact on financial statements. For the income statement, depreciation will be an expense, so it will reduce my income or it will increase my expenses. And for the balance sheet, your fixed asset will be shown as your cost less your accumulated depreciation. So we will look at it, how would it look at the end of this practice question, but let's quickly do this practice question so that we can delve into the main things of depreciation. So what are we giving you? We are giving you information on the books of ABC traders at the financial year end of 2025. What is the fixed asset that the business have? So we have a vehicle, which is a delivery van. Okay, we have purchased it on 1 March 2022. Okay, so we have it already for a while. Cost price was 300,000, useful life 5 years, no residual value, and we are using it on the straight line method. We also have equipment, which consists of an office printer. We have purchased on 1 March 2023, so we have already done 1 year of depreciation, and now we have to do the next year of depreciation. Why do I say that? If you look at when it was purchased and what is our financial year end, so when the date when we purchased it was on 1 March, which is the beginning of the financial year end. So it's from 1 March 2023 till 28 Feb 2024. So that was my first year. And now I have to go and calculate what is my equipment depreciation based on year 2. And the reason why I'm going through that in detail is because the office printer is depreciated by means of the diminishing balance method. Cost price of 60,000, useful life of 4 years, a residual value of 4,000 Rand. What is required from you guys? First of all, we have to calculate the vehicle's depreciation and also the printer's depreciation. We have to show it in journal entries, in the income statement, and then also in the balance sheet. Okay, let's go to the solution of the vehicle. The vehicle was for 300,000, 5 years, and then on the straight line. So that one is the most easiest one. So there's my 300 less 0. What is that 0? That is your residual value, which is 0, divided by 5. So for this vehicle, for the next 5 years, or for the 5 years that we are going to use this vehicle, depreciation will be at 60,000 Rand. Printer, not so easy. Let's look at it. So 60,000 is my year, or let me start from the first. As I already said, that year 1 will be the 2024 financial year end. So this is a calculation just to assist us to come to the depreciation that we have to calculate in 2025. So there's my cost price minus my 4,000, which is my residual value, times 25 or divide by 4. Okay, the scenario gave us it in 4 years. So we can also have it over 4 divided by 4. So that is 14,000. So for year 1, which is the 2024 financial year end, that is then a 14,000 depreciation for the printer. But we want to know what is the depreciation in year 2, which is then the 2025 depreciation. So we take the 60,000 less my 4,000, okay, my residual value, less the previous years of depreciation, times 25%. So in year 2, which is our current year, depreciation for the printer will be 10,500. What is my journal entries? For the vehicle, we will debit our depreciation for 60,000, credit my accumulated depreciation for 60,000. For the equipment, exactly the same. We will depreciate, debit depreciation for 10.5, credit accumulated depreciation for 10.5. What is the effect on my income statement? Well, there's an expense, so we will just add them together, and so the depreciation expense for the year will then be the 70,500. For the balance sheet, however, this is then where we split it. For the vehicle, my cost price was 300,000. Accumulated depreciation is now already for 3 years. Remember, we have purchased that vehicle on 1 March 2022. So until 2025, it is 3 years. We note on the straight line. So 60,000 times 3 give me then the 180,000. So my carrying value is then 120,000. For the equipment, cost price was 60,000. How did we get to the 24,500? Well, remember, it was the 14,000 depreciation in year 1, and then the 10,500 for year 2. So those two together give me then my 24,500. And then my carrying amount is basically just the difference. I just want to stress again that your residual value, we don't mention it anywhere in our financial statements. It is just how we calculate our depreciation when your residual value is of the essence. I just quickly want to delve in a little bit of background, or not background, but just some common mistakes that we as teachers see when our learners or students, what they are making mistakes in depreciation. So first of all, make very sure that you know whether it's the straight line or the diminishing balance method. Very important. The incorrect formula, you forgot to reduce it with the residual value. Then you misinterpreting the time periods. So you are not counting on your fingers. We can see at university level, we can see very quickly what subject is written if I see the students counting on their fingers. So remember, it's not a sin. Use your fingers. At least you've got 10 out of the 12 that you can use. Then you must always check what is the disposal or the purchase date of this asset to make sure that you have pro rata that depreciation for the months that you are using it. I want to stress again, don't forget about residual value. Then incorrect journal entries, and this is where you don't know that assets will reduce on the credit side. So make sure, and please don't learn this as a parrot. The logic of it must make sense. So bank is an asset gets more on the debit side. So that is very important that you know why is it debiting, why is something crediting. Okay, so not updating accumulated depreciation. So that is more on the diminishing balance method. Make sure that you take it year for year to calculate what is the correct depreciation for the correct year. And then you are then sometimes students or candidate learners will then also confuse the depreciation with an asset disposal. So those asset disposal only later in your school years, but that's also very important principles. So what is the conclusion? So depreciation is essential for accurately reflecting the asset value and the business expenses. You have to understand the methods, diminishing versus your straight line method, the calculations, okay, taking into account your residual value and also the months of the year, what you are using it for, and then the accounting entries, the debit and the credit. Those are the key topics. So thank you very much for listening to me. Thank you so much for this opportunity again, and I hope that you will have a wonderful day further. Thank you guys, and goodbye.